Welcome back to the Profitable Mindset Podcast, everyone. We talk a lot about mindset here, but today we're going to dig into something that can make or break any leader or business owner, really anyone trying to build a future. We're talking about risk management.
Risk management, yeah, absolutely essential. But, it's not just about avoiding risk.
Right. Because if you're not taking any risks, you're probably not growing either, right?
Yeah, exactly. It's about leveraging risk. It's about using risk as a way to find the biggest opportunities.
It's about seeing risk, I guess, not as this scary monster, but as maybe a compass, like a tool to guide you.
A compass, a tool, that's a great way to put it. Visionary leaders, they don't just try to avoid risk. They actually, they use it to their advantage. They see change as inevitable, and then they adapt. They adapt their strategies as the markets shift.
Okay, so they're not just reacting to what's happening. They're kind of anticipating things.
Yeah, they're proactive. They're always a step ahead. But I think before we go too far into that, we need to really break down what we're talking about when we say risk.
Okay, yeah. Risk is a pretty broad term. What are the different types of risk that people should be thinking about?
So you've got market risk, right? That's the day-to-day volatility. It's just the natural ups and downs that we see.
Okay, that makes sense. The market's never going to be perfectly stable.
Right. And then you've got liquidity risk. So that's how easily you can buy or sell an asset without moving the price too much.
So can you get into a position and get out of a position without, causing a big ripple effect?
Exactly. That's liquidity risk. Then there's credit risk. So the risk that somebody is not going to pay you back if you've lent them money. Operational risk. That's more about things that can go wrong internally, like systems crashing or just human error.
Oh, yeah. The human element, that could definitely be a risk factor.
Oh, huge, yeah. And then there's systemic risk. This is when, the whole system is in trouble. Think like the financial crisis.
Okay, so it's not just one company or one market. It's the bigger picture.
The whole enchilada. And then there's one more that a lot of people don't talk about enough, and that's psychological risk.
Psychological risk. Okay, I'm intrigued. What's that all about?
That's the risk that comes from within. It's our own emotions, our own biases, our own fears, and that can be the biggest risk of all.
So letting fear or greed kind of take over and cloud your judgment?
Yeah, exactly. Think about it. Fear of missing out, fear of losing everything, greed, hope, even regret. All of those emotions can lead you to make bad decisions.
Oh, I can definitely relate to that. I've definitely made some impulsive decisions driven by fear or excitement.
We all have, right?
Yeah.
But the thing is, if you want to make good decisions, you have to be aware of these emotional triggers.
You have to kind of master your own mind before you can master the market, right?
Exactly. Once you understand these different types of risk, then you can start building a framework to actually manage them.
Okay, so let's talk framework. It sounds kind of complicated, but how do you actually manage risk when there are so many different types? Where do you even begin?
I think the first thing is just identifying the risks that are relevant to you. What are the potential threats to your business, your investments, whatever it is you're doing?
Okay, so kind of assess your vulnerabilities, right?
Yeah.
See where you're exposed.
Right, exactly. Then you assess the impact. How likely is it that each risk will actually happen? And if it does, how bad will it be?
You're basically creating a risk profile, like mapping out the terrain.
Love that. Mapping out the terrain, perfect analogy. And once you have that map, then you can start thinking about mitigation. How can you reduce your exposure to each of those risks?
Okay, so you identify, you assess, and then you mitigate. You start putting those safeguards in place.
Exactly. And the final piece is monitoring and review. Because things change, right? The markets change, your situation changes, so you have to go back and reevaluate your risks and adjust your strategies as needed.
So it's not just a one-time thing. It's an ongoing process.
It's a constant process, yeah. Having a plan is great, but sticking to it when your emotions are running high, that's the hard part. That's where emotional discipline comes in.
Yeah, because it's easy to get swept up in the excitement or the fear, and then all logic goes out the window.
Exactly. Emotional discipline is the bridge between your strategy and your results. It's what separates the successful traders and investors from everyone else.
So it's not just about having a good plan. It's about having the discipline to actually execute that plan, even when things get tough.
Couldn't have said it better myself. So we've talked a lot about different types of risks, building a framework, emotional discipline, all that good stuff.
Right, how to really think through your approach, not just jump in.
Exactly. But, a lot of people are probably wondering, okay, but how do I actually protect myself? What are the tools? What are the tactics?
Yeah, how do you build that resilience, especially when the markets are totally unpredictable.
Right, because things can change so fast. And one of the most powerful tools, honestly, one of the simplest, is diversification.
Diversification. Yeah, that old saying, don't put all your eggs in one basket.
Exactly. It's
That's it.
timeless wisdom. But a lot of people think diversification just means like, oh, I'll buy a bunch of different stocks. But it's actually more nuanced than that.
So it's not just about having a lot of different things in your portfolio.
No, it's about understanding how those different things relate to each other. It's about correlation.
Correlation, okay.
Okay.
Explain that one to me.
So correlation is how different assets move in relation to each other. Like, do they tend to go up and down together, or do they move in opposite directions?
Okay, so if one thing's going down, you want something else that's maybe going up to kind of balance it out.
Exactly. You want assets that have low correlation or even negative correlation. That way, if one part of your portfolio is struggling, another part might be doing well. It creates a buffer.
So it's kind of like building a team, right? You want people with different strengths to cover all the bases.
Exactly. A well-rounded team. And when you're talking about diversification, there are different levels. Like, first, you've got asset class diversification. That's like stocks, bonds, real estate, commodities, maybe even some crypto.
Okay, so spread it out across different types of assets. What else?
Then, within each asset class, you can diversify even further. So like within stocks, you might invest in different sectors: tech, healthcare, energy, financials, whatever makes sense for you.
So even if one sector is having a rough time, the others might be doing okay.
Right. It's about spreading that risk out as much as possible. And then you can also diversify geographically. Don't just limit yourself to your home country. Look at international markets, emerging markets, developed markets. The whole world's your oyster.
Wow, so you can diversify across asset classes, sectors, and even geographies.
Yep, it's about covering all your bases. And don't forget about time diversification.
Time diversification, what's that?
That's about spreading your investments out over time. Like,
Yeah.
don't put all your money in at once. Invest gradually over weeks, months, even years. That way you're not buying everything at the top of the market.
Okay, that makes sense. Smooth out those ups and downs.
Exactly. And then the last one is strategy diversification.
Okay, so that's not about what you invest in. It's about how you invest.
You got it. You might have some long-term investments, some short-term trades, some value investing, some growth investing, mix it up.
So you're not just relying on one approach. You've got different strategies working for you.
Exactly. It's like having multiple tools in your toolbox.
Okay, so diversification is about spreading your risk, building that resilience into your portfolio, and making sure you're not overly exposed to any one thing.
Exactly. But remember, it's not just about diversifying for the sake of diversifying. It's got to be strategic. It's got to align with your goals, your risk tolerance, your whole investment philosophy.
Right, because you can diversify too much, right?
Exactly. If you spread yourself too thin, then your returns might be really low and it becomes really hard to manage. So finding that balance, that's the art of it.
So it's not just throwing darts at a board. It's about making deliberate choices about where you allocate your resources.
Exactly. It's
Yeah.
all about having a plan, a well-defined plan. And then within that plan, another key element is position sizing.
Position sizing, yeah, we hear that term a lot. What does that actually mean?
Position sizing is all about how much you risk on any given trade or investment. Like, how much are you willing to put on the line?
So even if you found this amazing opportunity, you need to be smart about how much you actually invest.
Right. Because even with a great strategy, if you get the position sizing wrong, it can wipe you out.
Oh, wow, so it's really that important.
It's huge. A lot of experienced traders, they use something called the 1-2% rule.
The 1-2% rule. Okay, what's that?
It means you never risk more than 1 or 2% of your total capital on a single trade. That way, even if you have a string of losses, you're not blowing up your account.
So if you have like $10,000, you wouldn't risk more than $100 or $200 on any one trade.
Exactly. It helps you stay in the game. Position sizing, it takes into account your risk tolerance, your stop loss levels, your potential reward, all of that.
Sounds complicated.
It can be, but there are tools out there that can help you. There are risk calculators, there's software, all kinds of things.
Okay, so you don't have to do all the math in your head.
No, definitely not. And then another big one related to risk management is leverage.
Leverage. Ooh, that one sounds a little scary.
It can be. Leverage is basically using borrowed money to amplify your returns. Like, you're putting down a small amount of your own money and then you're borrowing the rest to make a bigger trade.
So you can potentially make a lot more money.
Right. But the flip side is that you can also lose a lot more money.
Hmm.
That's why it's so important to be really careful with leverage.
So it's like a double-edged sword.
Exactly. If you're not careful, leverage can cut you. And then the last thing I want to talk about in this section is black swan events.
Black swan events. Now that sounds ominous. What are those?
Black swan events are those rare, unpredictable things that nobody sees coming, but they have a massive impact, like the 2008 financial crisis, the pandemic, that kind of thing.
Okay, so the big unexpected shocks to the system.
Right. And the thing is, you can't really predict them, but you can prepare for them.
So it's not about trying to figure out what the next black swan event will be. It's about making sure you're ready for anything.
Exactly. There are a lot of different strategies you can use, like stress testing your portfolio.
Stress testing, what's that?
It's basically simulating different scenarios, like a market crash or a recession, and seeing how your portfolio would hold up.
Oh, so you're kind of running it through a worst-case scenario to see if it can survive.
Exactly. Another big one is maintaining liquidity.
Liquidity, you mean having enough cash on hand.
Right. That way, if things go south, you're not forced to sell your investments at a loss. You can actually buy more, potentially at a discount.
Okay, so liquidity is like having an emergency fund for your portfolio.
Exactly. And then, of course, diversification comes in again.
Hmm.
The more diversified you are, the less likely you are to be completely wiped out by a single event.
Right, because everything won't go down at the same time.
Exactly. And then there's hedging.
Hedging, remind me what that is again?
Hedging is like buying insurance for your portfolio. It's taking an offsetting position so that if your main investment goes down, you have something else that goes up to kind of cushion the blow.
So if you're worried about the stock market crashing, you might buy something that would go up if the market goes down.
Right. You could use put options, inverse ETFs, things like that.
Okay, so hedging is like creating a safety net.
Exactly. The main point here is that you can't predict black swan events, but you can prepare for them. And that's a huge part of being a successful trader or investor.
Okay, so we've talked about diversification, position sizing, black swan events. What's next?
Well, now we need to zoom out a little bit and talk about macro trends.
Okay, so we've talked about diversification, position sizing, black swan events, those big market shocks. Now, let's zoom out even further and talk about macro trends. What are those?
Yeah, macro trends, those are the big picture forces that are shaping the world. Think like interest rates, inflation, economic growth, geopolitical events, that kind of stuff.
Okay, so it's not just about what's happening in the stock market, it's about what's happening in the world, right? Like the bigger picture.
Exactly. It's the big picture. And those macro trends, they have a huge impact on the markets.
So why is it so important for investors to understand macro trends?
Because it helps you see the forest for the trees, Like if you're just focused on the day-to-day price movements, you're missing the bigger picture. And that bigger picture can tell you a lot about where things are headed.
Okay, so it's like having a map, right? A map to help you navigate the markets.
Exactly. And there are certain macro indicators that are really important to watch, like interest rates, for example.
Interest rates, yeah, those seem to be in the news a lot lately. Why are they so important?
Well, interest rates affect everything. They affect how much it costs to borrow money. They affect how much you earn on your savings. They affect how businesses invest. They affect the value of different assets.
Okay, so if interest rates are going up, that means it's more expensive to borrow money, which could slow down the economy.
Right. And it could also make bonds more attractive relative to stocks.
Okay, so interest rates can have a big impact on the stock market too.
Absolutely. And then there's inflation.
Inflation, that's when prices go up.
Right.
Like everything gets more expensive.
Exactly. And inflation can be a big problem for investors because it erodes the value of your money.
Oh, so if your investments aren't keeping up with inflation, you're actually losing money.
That's right. So you have to be strategic about how you invest during periods of high inflation. You might want to look at assets that tend to do well when inflation is high, like commodities or real estate.
Okay, so it's about adjusting your strategy based on what's happening with inflation.
Exactly.
Yeah.
And then there's economic growth. Is the economy growing or shrinking? How fast is it growing? That's another really important macro trend to watch.
Because if the economy is doing well, businesses are more likely to do well, and the stock market's probably going to go up, right?
Right. Generally speaking, yes. But if the economy is slowing down, that could be a sign of trouble ahead.
Okay, so you're looking at interest rates, inflation, economic growth. What else?
And then, of course, there are geopolitical events, wars, elections, trade deals. All of that stuff can have a big impact on the market.
Yeah, that's kind of hard to predict though, right?
It is. But it's important to be aware of what's going on in the world and how it might affect your investments.
Okay, so it sounds like understanding macro trends is pretty complex. Like, do you need to be an economist or something to do this?
Well, you don't need to be an expert, but you do need to stay informed. Read the news, follow economic reports, listen to podcasts like this one. The more you know, the better prepared you'll be to make smart investment decisions.
Okay, so let's say you've been paying attention to all these macro trends, and you're starting to see some signs that things might be changing. Like maybe the economy is slowing down or inflation is picking up. What do you do?
That's where adaptive strategies come in.
Adaptive strategies, meaning you need to be flexible, ready to change your approach.
Exactly. No single strategy works forever. You got to be able to adapt to the changing conditions.
Okay, so how do you actually do that? How do you build that adaptability into your investment plan?
Well, first, you need a solid framework, right? Like we talked about before. You got to have a plan, a set of guiding principles. But then within that framework, you got to be able to make adjustments based on what's happening in the market.
So it's like having a map, but knowing that you might need to take a detour or two along the way.
Exactly. And one of the most important things to be aware of is volatility.
Volatility, that's how much the market is moving up and down, right?
Exactly. And volatility can change a lot depending on what's going on in the world. Like during a crisis, volatility tends to spike.
Okay, so if volatility is high, that means that the market is more risky.
Right. And that means you might need to adjust your position sizes, your stop loss levels, your whole approach.
So you're not just sticking to the same plan no matter what. You're being flexible.
Right. You got to be able to roll with the punches.
Yeah.
That means being willing to change your mind, adjust your strategy, even take a loss if you need to.
Okay, so adaptability is all about being flexible, being data-driven, and not being afraid to make changes when the market tells you to.
Exactly. And that brings us to one of the most important topics of all, and that's technology.
Technology. Yeah, it seems like technology is changing everything these days. How is it impacting risk management?
Well, technology is giving us so many new tools and resources to help us manage risk. Like there's software that can track your portfolio, analyze market data, even execute trades for you.
Wow, so you can basically automate a lot of your trading.
You can. There are trading bots, algorithms, all kinds of things. But, it's important to remember that technology is just a tool. It's not a magic bullet.
Right, you still need to understand the fundamentals. You still need to have a strategy.
Exactly. Technology can help you execute your strategy more effectively, but it can't replace the need for human judgment and intuition.
Okay, so technology is a powerful tool, but it's important to use it wisely.
Absolutely. And speaking of learning, one of the most important things you can do as a trader or investor is to learn from your mistakes.
Mistakes. Yeah, nobody likes to talk about those, but it seems like they're kind of inevitable, right?
They are. Everyone makes mistakes. The difference between successful traders and unsuccessful traders is that successful traders learn from their mistakes.
So how do you actually do that? How do you turn a mistake into a learning opportunity?
Well, the first step is to acknowledge the mistake. Don't try to sweep it under the rug. Then analyze the mistake. What happened? Why did it happen? What could you have done differently?
Okay, so you're basically doing a post-mortem on the trade.
Exactly. You're trying to figure out what went wrong so you can avoid making the same mistake again.
Okay, that makes sense. And what's the best way to track all of this? Like, how do you keep track of your mistakes and what you're learning?
The best way is to keep a trading journal.
A trading journal. Okay, what is that?
It's basically a record of all your trades, your analysis, your thoughts, your emotions.
So it's like a diary for your trading.
Yeah, kind of.
Yeah.
It helps you see patterns in your behavior, identify your strengths and weaknesses, and track your progress over time.
Okay, that sounds really helpful. So we've talked about a lot of different aspects of risk management today, but if you had to boil it all down to one key takeaway, what would it be?
I think the key takeaway is that risk management is an ongoing process. It's not something you do once and then forget about it. It's something you have to be thinking about all the time, constantly
Yeah.
evaluating and adjusting your approach.
So it's not about eliminating risk altogether, it's about managing it effectively.
Exactly. Risk is part of the game, but it's how you manage that risk that determines whether you win or lose.
This has been a really insightful conversation. Thank you so much for sharing your expertise with us today.
It's been my pleasure.
And to all our listeners, thank you for tuning in to the Profitable Mindset Podcast. We hope you found this episode valuable. And remember, stay curious, stay informed, and stay profitable.